So you want to earn some free money? Well, who doesn't, to be fair? And in this little video, it's BG Dollars, and I will be showing you just that. Now, all the rich people do this, all big businesses do this. Even if they've got 3 billion in the bank, they're still going to get some hands on their free cash. And all it involves is just waiting for the interest rates to drop. And when you've got very low interest rates, taking out a loan at very cheap interest rates, because obviously they're so low, and then just putting it into the markets. That's all it is. Now, of course, you've got big investors that don't need cash, but they'll still take out loans to do this because it's free money at the end of the day. It's very, very simple. And I'm just going to show you how you do it. First of all, you are going to want a very good, clean credit score for this. Because obviously, the better your credit score, the cheaper your loan rate will be. Therefore, the more money you make. And also, if you've already got money behind you, then you could probably access a bigger loan in terms of money-wise. Then you could also make more money. Because if you make 7% profit on a 100 grand loan, that's more money than a 7% profit on a 10 grand loan. So if you've got a big bit of cash behind you and you've got a very good credit score, this is perfect for you. If you haven't got a bit of cash, don't worry, because there's still time to build it up, because we're still quite away from when we can actually get started on this. But anyway, let's get into what it actually involves. As you can see here, look, this is the interest rate chart. And obviously, during 2007, 2008, we had a recession and interest rates dropped massively. And there you are, look, in December 2008, they reached 0.16. Now, we wait 6 months to see if that is the bottom. Because you can have negative interest rates, don't forget. They can keep going into the negatives. Now, the US have never had a negative interest rate, but some places do. So, yeah, you need to just wait. So from December 2008, you can see it's right at the bottom, 0.16. So let's just wait 6 months. June. So you can see 6 months, the interest rates haven't really moved. So that's your first bet. June 2009, you want to take out a loan at a cheap interest rate. And let's go over to the markets and see what would have happened. Now here we are. Look, I've already marked it on my chart. Here's June 2009. And as you can see, we're buying right at the, well, not the very bottom, but the almost bottom. So yes, June 2009, interest rates haven't moved for 6 months. So you take a loan out at a cheap interest rate, preferably early single digits. You want a loan for about 2 to 3%, and you're going to take it out for 5 years, all right? So 5 years at hopefully 2 to 3% if you can get it. And of course, you're just going to wait for the market. And of course, June 2010, let's have a little look where it is here. June 2010, you're here. So you've already made over 10% on your returns, and obviously you've got the loan at an interest rate of 2-3%. So you're making a profit of about 7 to 8% in the first year. Let's see, June 2011, where were you? I think you were around here, June 2011. So again, you were higher, and you're probably you've now made about 20%, just over 20%. Within the first 2 years. And of course, your loan period is 5 years, and you only have to pay 2 to 3% interest rate on the loan. So you're making big bucks. And as I said, if this is a 100 grand loan that you've pumped into the markets, 20% of 100 grand is 20,000. So you're starting to think you're making big money for doing absolutely nothing. Just simply taking a loan out at low interest rates and putting it into the markets. But of course, that's the first 2 years, and obviously we had a dip and we sort of went up and up and up. So 5 years from there, you would have been about up here. Look, 2013, 2014, you'd have been up here. So you'd have made big money. But of course, that's not the only time that the interest rates have dropped. And we want to make sure that this is a strategy that we can use every single time. So we're going to have to see if it worked in the past every single time. So the next time we saw it drop was 2002. So about 7 years earlier. And let's see what happened. So here we are, June 2002, you'd have bought in here. And let's just check on the chart. So yeah, December 2001, look, you had interest rates drop to 1.82. February, they dropped again to 1.74. And then for about 6 months, look, they didn't really do much. They just petered out. So that's when you'd have got a loan out 6 months after the interest rates have dropped quite a bit. And they haven't done much. So you'd got a loan out in June 2002. And you'd have invested into the market just around here. As you can see, the 17th of June 2002 is here. And of course, you'd have taken a loan out for 5 years again. And then you would have at 2 to 3% interest rate. And June 2003, you would have actually broke even. But of course, your loan on your interest rate is 2 to 3%. Obviously, if you can get it less than that, the less the better. But we're just going for a 2 to 3% interest rate. So you would have actually lost money on the first year, you lost 2 to 3%. You would have made no money in the stock market, and you'd have lost your 2 to 3% on the interest rate. So the first year was a bit rough, but let's see what happened in the next year. Oh look, here we are. Look, June 2004, we're up here. So that's just an 11% return you'd have got in the following year. So you've actually gained money now, because the first year you lost 2 to 3% because of the interest rate. In the second year, you gained about 9% after the interest rate on the loan. So that means you'd have made money. And then let's see where we would have ended up in the third year. We'd have been up here. So just a little bit higher again. So it just goes to show, if you take a loan out at low interest rates when they've been low for about 6 months and nothing's really happened to them, that is when you just make free money. If you have a good credit score and you can get a big loan with a very low interest rate, that's where you're making your big bucks. But again, let's go back. Where else? Oh, around here. 1990s, they dropped for quite a while. Do we have one? I think I put a line at the 1990s. Here we are, look. 14th of June 1993. Let's go to the fund rate, see if that's correct. So yeah, look, December 1992 we hit a bottom, and we were flat, weren't we, for the next sort of year or so. So 6 months after December 1992, June 1993. So you would have got in here. Again, interest rates were very low. If you can get a 2 to 3% loan during that period for 5 years, you'd have been laughing, because the next year, June 1994, boom, you'd have lost money in the first year. Or actually, you would have been about break even. So break even in the first year. Let's see June 1995. Whoa, look at that. We've made big bucks. If we look at June 1996. Whoa, look where we are now. We're up to 600 from when we bought it all the way down here. So of course, the interest rate on the loan is a lot less than the returns we got in the market. So therefore, you've made money. It's that simple, folks. When interest rates go down, the markets go up. Why? Because that's when businesses come in and also take out loans. All the rich people take out loans, and there's a lot more buying, and people just buy up assets. As I said, Apple, Amazon, Warren Buffett, they're all going to take out loans when interest rates are low. Why? Because it's just free money. Because rich people can just take out loans, boom, and just stick it in the markets knowing that they're going to get a good return. And it's going to be more than the interest rate, so they've made money on it. It's as simple as that. It's not hard to do. Now, of course, the next one here, look, it was a little bit bumpy. So we can't really count this period because it was up and down. It wasn't really flat. Of course, with years back, we're looking at 1975 now, the interest rate was at 5%, which means it was a lot harder to do back then. As you can see, as time's gone on, we've generally got lower and lower interest rates. That's because our policies have just been better, our economics has been better, we've got smarter, we've got more technology to deal with money, recessions, inflation, all this, that. So in general, a lower interest rate is always better for the economy, and it's always better for business growth, and it's always better for employment. It's just better for the whole society in general. So we always want to have interest rates as low as possible. But of course, it does now to this day, and every rich person does do it. They wait for interest rates to get so low. Look at this, 0.1% of an interest rate. And the wealthy people are accessing loans at 0.5%, 1%, 0.7%. And of course, if you've got a squeaky clean credit score, like I'm talking 50, 60 years of history on your credit report, that you've never missed a payment in all that time, and you've got a lot of wealth behind you, then you could take out huge loans at very, very low interest rates and just make free money. And that's all they do. That's all you got to do. As I said, if you've got money, it's very simple to make money. At the bottom line is. So yeah, that has been BG Dollars. I hope you enjoyed. If you have, please do like, subscribe, comment. Of course, Friday my show's coming out. I'll say it's new. It's out every Friday now. Finance Fridays. I'll hopefully be streaming it this Friday, so please do come join me at that. I think it's 7 p.m. GMT. So 7 p.m. GMT, I'll be streaming that one. Yeah, as I said, to BG Dollars, do subscribe, and I'll see you in the next one, people.